Welcome to Zen. Today we're going to take our time exploring the top 10 tax mistakes you want to avoid, so you can keep more money in your pocket. But before we dive in, we want to hear from you. What is the most valuable tax tip or strategy you've learned over the years? Share your wisdom in the comments below. Your insights might help someone else on their journey to financial freedom. Let's get started and help you make the most of your taxes. Mistake number 1: missing deductions and credits. Deductions and credits are essential tools for reducing your tax burden and maximizing your return. Missing out on these opportunities can mean leaving money on the table. There are many different types of deductions and credits available, depending on your situation. For instance, if you're a small business owner or a freelancer, there are numerous expenses you can deduct, such as office supplies, travel costs, and marketing expenses. Keeping good records of these expenses can save you a lot of money at tax time. Medical expenses can also be deducted if they exceed a certain percentage of your adjusted gross income, AGI. If you had significant medical bills this year, keep track of receipts and documentation to support your claim. Credits directly reduce your tax bill, such as the Earned Income Tax Credit, EITC, for low to moderate income workers and families. The Child Tax Credit can significantly reduce taxes for families with children. To avoid missing out on deductions and credits, stay organized by keeping detailed records of your receipts and expenses throughout the year. Consider using tax software or consulting a tax professional to ensure you take advantage of all available opportunities. Now let's talk about mistake number 2, filing late or not filing at all. Filing your tax return late can lead to costly penalties and interest charges that accumulate over time, increasing your tax burden. Additionally, failing to file altogether can result in audits or legal action in some regions. Filing late may result in fees starting with a flat fee or a percentage of your outstanding balance, which can quickly add up. Moreover, interest charges on unpaid taxes can inflate your bill and strain your finances. To avoid these costly consequences, mark important tax dates on your calendar and set reminders to keep track of filing and payment deadlines. If you can't pay your taxes in full, file your return on time to avoid penalties. You can request a payment plan from your tax authority to pay the remaining balance over time. In some cases, requesting an extension may be a viable option if you need more time to prepare your return. However, keep in mind that an extension gives you additional time to file, not to pay. Make sure to pay any owed taxes by the original deadline to avoid penalties. Mistake number 3 is not keeping proper records. Proper record keeping is essential for accurate and successful tax filing. Failing to maintain organized financial documents can lead to tax problems down the road, such as missing out on deductions, struggling to prove your income, and facing challenges if you're audited. A good record-keeping system includes categorizing receipts, invoices, and bank statements for easy access when needed. Consider using digital tools like scanning apps and software for expense tracking. These tools can help you organize your records and keep everything in one place. Regularly check your records for completeness and accuracy. This includes reviewing your receipts, invoices, and financial statements to ensure all transactions are recorded and categorized correctly. By doing this consistently, you'll be prepared for tax season and avoid unnecessary stress. Common mistake number 4: choosing the wrong filing status. Your filing status affects your tax rates, deductions, and credits, making it one of the most crucial choices you make when filing your taxes. Choosing the wrong status can lead to paying more taxes than necessary or missing out on potential savings. Filing statuses include single, married filing jointly, married filing separately, and head of household. Each status has its own benefits and considerations. For married couples, married filing jointly often provides the most favorable option, offering lower tax rates and more access to credits and deductions. However, it's essential to evaluate your combined income and expenses to confirm it's the best choice for your situation. Married filing separately may be beneficial in certain circumstances, such as when one spouse has significant medical expenses or other itemized deductions. Weigh the pros and cons before deciding. Head of household status can be advantageous for single parents or those supporting other dependents. This status often results in lower rates and a higher standard deduction, saving you money. Don't just stick with the same filing status out of habit. Review your options each year and consult a tax professional if needed. Mistake number 5: ignoring regional tax differences. Tax laws and rates can vary significantly depending on your region. Ignoring these differences can catch you off guard when it comes time to pay your taxes. Each area may have its own specific tax laws, whether state, provincial, or municipal, that can impact your tax liability. Research your area's specific tax laws to understand potential deductions and credits available to you. Local tax incentives can vary widely and offer opportunities for savings. For example, some regions provide credits for renewable energy projects, small businesses, or educational expenses. Tax rates also differ by region, affecting your overall tax liability. Knowing your region's rates can help you plan smarter and save more. Stay informed about changes in tax laws and rates by keeping track of updates throughout the year. Mistake number 6 is misclassifying your income or expenses. Properly classifying your income and expenses is essential for precise tax reporting. Misclassifying income or expenses can lead to tax issues such as overpaying or underpaying taxes, which may result in penalties or audits. When it comes to income, remember to always report all sources, including side hustles, freelance work, rental income, and investments. Classify income correctly as either active or passive to ensure accurate tax reporting. Properly classifying your income and expenses is essential for precise tax reporting. Misclassifying income or expenses can lead to tax issues such as overpaying or underpaying taxes, which may result in penalties or audits. When it comes to income, remember to always report all sources, including side hustles, freelance work, rental income, and investments. Classify income correctly as either active or passive to ensure accurate tax reporting. Mistake number 7, overlooking retirement account contributions. Retirement account contributions offer significant tax benefits, and overlooking them can mean missing out on valuable deductions and lower taxable income. By maximizing your contributions to retirement accounts such as a 401k or IRA, you can plan for your financial future while reducing your tax liability. These contributions are often made on a pre-tax basis, lowering your adjusted gross income, AGI, and potentially qualifying you for additional deductions and credits. For those aged 50 and older, catch-up contributions allow you to add more to your retirement accounts and lower your taxable income further. Contributing to retirement accounts not only reduces your tax liability in the short term but also provides long-term financial security for your future. Consult a financial advisor to understand the best retirement savings strategy for your specific situation and to maximize your benefits. Mistake number 8, forgetting to report all income. Well, it happens sometimes. Accurately reporting all your income is crucial for avoiding penalties or audits. Forgetting to report all your earnings, including side hustles or investment income, can lead to significant tax problems. Keep track of all income sources throughout the year, such as wages, freelance work, rental income, and investments. Make sure to account for all forms of income, including dividends, interest, and capital gains. Forgetting to report all income can raise red flags for the tax authorities and lead to penalties or audits. Organize your income records by keeping W-2s, 1099s, and other income forms in a safe and accessible location. Proper documentation ensures a smooth tax season and helps you avoid costly penalties. Now let's discuss mistake number 9, incorrectly calculating estimated taxes. Underestimating or overestimating your estimated taxes can lead to penalties or missed opportunities for potential investment income. There has to be a balance. Accurately calculating estimated taxes ensures you're paying the right amount each quarter and helps you avoid financial setbacks. If you are self-employed or have significant investment income, you may be required to pay estimated taxes quarterly. Use tax software or consult a tax professional to calculate your estimated taxes based on your expected income and deductions. Set reminders for quarterly payment deadlines and keep track of your payments to avoid penalties. If you experience significant changes in income or expenses during the year, recalculate your estimated taxes to reflect these changes and adjust your payments accordingly. Like they say, last but not least. Mistake number 10, not taking advantage of tax-advantaged accounts. Curious? Let's dive right in. Tax-advantaged accounts such as health savings accounts, HSAs, flexible spending accounts, FSAs, and retirement accounts offer significant tax benefits. Missing out on these opportunities can result in paying more taxes than necessary. HSAs and FSAs allow you to set aside pre-tax dollars for medical expenses, saving you money on both taxes and healthcare costs. By maximizing contributions to these accounts, you can reduce your taxable income and plan for future medical expenses. HSAs and FSAs have specific rules on eligible expenses, so make sure to understand the guidelines and use the accounts wisely. Leverage retirement accounts such as 401(k), and IRAs to save for your future while benefiting from tax advantages. These accounts offer potential deductions and lower your taxable income, helping you plan for a secure retirement. We hope this deep dive into common tax mistakes has equipped you with valuable knowledge to take control of your finances and keep more of your hard-earned money centers. If you found today's video helpful, make sure to hit that subscribe button and turn on notifications so you never miss out on our latest tips and tricks for financial success. Thanks for watching, and until next time, take care and keep aiming for financial freedom.